no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans, and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
Today's podcast is sponsored by NetSuite, the easy-to-use cloud-based business management software for every aspect of your business. Download the CFO's Guide to AI and Machine Learning at netsuite.com/gold. The guide is free to you at netsuite.com/gold. This episode is sponsored by Momentous. If you're interested in making a true investment in your health, go to livemomentous.com and use code GOLD to get 20% off your new routine today.
The Peter Schiff Show.
Well, welcome everybody. This is the 1000th episode of the Peter Schiff Show podcast, and I was hoping that it would go a lot smoother. In fact, as you can see, I'm in my studio, but I'm not in my normal position here because we had some technical difficulties with the equipment. Maybe it started, I did a hit on Fox Business earlier today, and I don't know what happened, and we haven't been able to get a hold of the people. I've been trying for an hour to get the studio equipment working properly. But so now I'm just doing it off a laptop, and it's going to be the 1000th episode. And it is a great day. Now, I was thinking of maybe postponing it, doing it later in the week, but a lot happened today. And so I thought it was important to do this podcast this evening. And so if I couldn't use the studio equipment, well, I'm just going to use whatever I got. Anyway, we got the widely expected, and as I said, Powell lowered interest rates. Jerome Powell, the Federal Reserve, lowered interest rates today by 25 basis points. And the only reason that the Fed did this was because the markets expected it, and Powell didn't want to disappoint the markets. Well, the markets didn't get the memo because the Dow Jones dropped over 1,100 points today. It was down with 2.5% on the day, and that was the best performing of the stock market indexes, although the Dow was down today for the 10th day in a row. Now, a losing streak that long hasn't happened since 1974. And, Gerald Ford was president, and we were in a brutal bear market at that time in the 70s with all the inflation that we had back then. They had a streak of 11 consecutive down days. So if we're down again tomorrow, we'll tie the all-time record. And if we're down again on Friday, which we could easily do, I could easily see the market down another 2 days, we would break a record. The Dow would have its longest losing streak in the history of the Dow. So that would include like the years of the Great Depression. So it's very rare that the Dow is down this many days in a row. In fact, I was, commenting yesterday, just watching all the news coverage of the stock market and just looking at how bullish everybody was. And of course, the NASDAQ made a new record high yesterday, even as the Dow was continuing its losing streak. And in fact, the breadth of the market has been very, very bad over the past several weeks, as investors have been enthusiastically buying anything speculative with a symbol, including cryptocurrencies or Bitcoin. You've had this animal spirits that were running wild on Wall Street based on optimism over Donald Trump and this super business friendly government. And nobody was bearish. Everybody was bullish. The market could only go up. And to me, it looked like a top. Like, everybody is wildly optimistic, and nobody could see the risks. And there were a lot of risks. There are a lot of risks because we had a very expensive market. The market was expensive before Trump won, and it became even more expensive after. But it was overlooking some very significant headwinds in the fact that we actually have a weak economy with rising inflation and rising interest rates. So this is a toxic combination for the markets, but investors didn't realize it. Today was a big wake-up call with Powell maybe inadvertently pulling the rug out from under the stock market, the rate rug, and the market collapsed because even though investors were prepared for the 25 basis point cut, I guess they weren't prepared for what came next. One of the things that Powell indicated was that, or the Fed, not just Powell, that there will be fewer rate cuts in 2025 than the markets anticipated. I think prior to today's announcement, the markets were expecting 4 rate cuts in 2025. And I think the markets had already adjusted that down to maybe 2 to 3. So one of them they kind of took off the table. So people were expecting a hawkish cut today, in that the Fed was going to cut rates, but simultaneously indicate that it wasn't going to cut as much as it had thought before. But I guess the markets hadn't fully priced in or considered what that means, because this whole stock market rally has been predicated really on lower rates, and the idea that this new easing cycle is going to propel the market higher, just like prior easing cycles. And I've known that there was going to be a lot of bumps on this road because I knew that the Fed was not making the progress on inflation that it had believed, or that it was claimed that it was having. And I think this was reality setting in when Powell talked about how inflation had picked up, how inflation was higher than the Fed had hoped or had anticipated, that it's taking longer to get inflation down to 2%. In fact, he said in the Q&A that he thinks it may take 1 or maybe 2 more years before inflation goes down to 2%. Now, I don't think it's going down to 2% at all in 2 years. So it's going to be a long wait. But if the Fed is going to have to wait 2 years to get inflation back down to 2%, well, it's going to have to be higher for longer than the markets expected. In fact, Powell even indicated that the neutral rate, the rate that the Federal Reserve believes is neutral for the economy, not stimulative, but not restrictive. They notched that up from maybe 2.8, 2.9% to 3%. And so that also means that there's fewer cuts necessary, maybe 1 less cut, to get down to where the Fed considers policy to be neutral. Now, the Fed did say that they still think they're well into restrictive territory. They lowered interest rates now down to 4.25, 4.5. So we're now a full 100 basis points lower than the peak. Although, despite this 100 basis point rate cut, the yield on the 10-year Treasury, which closed above 4.5 today, is now better than 80 basis points higher than it was when the Fed started to cut. So the Fed went down 100, but the market went up 80 on the 10-year, and even a little bit more on the 30-year. This hasn't happened in recent times, where the Fed has been cutting and the market has been moving in the other direction. And this shows that the markets are not believing the Fed to a degree. They're concerned about the growing deficits. In fact, they have this continuing resolution that is working its way through Congress now to keep the lights on. And that includes 110 billion of new spending, in addition to all the other spending, an extra 110 billion. Also, they threw in a raise. I guess that Congress is upset they haven't gotten a raise in the last 10 years. So they slipped a pay hike for themselves into this continuing resolution. But that alone adds another 110 billion to the debt over the next year, in addition to everything else that's adding. They're talking about the Doge, commission to cut spending. They're already increasing it beyond where it already was. And in fact, the House of Representatives passed this Social Security Fairness Act. Who's going to be against Social Security fairness? But what it does is it increases benefits to civil service workers who are getting less benefits. Now this is going to change that so they get full benefits. That costs an extra $20 billion a year. Just throw that onto the pile. And of course, if they estimate $20 billion a year, it's probably going to cost a lot more than that. But these guys are still adding on new government spending as deficits are exploding out of control. So the bond market is concerned about this. Now, I think it would be a lot worse for the bond market if the dollar was falling, but it's not. The dollar surged today to a new 2-year high, dollar index above 108. The euro, I think, is it down to 103? Let me check where it is. The euro is trading at just under 104. So 103 and 3/4. It closed. It's up a little bit in the evening. It was at 103 and a half. But dollar index above 108. So the dollar is soaring. It's the only thing that was up today was the dollar. Everything else, the stock market, the bond market, the Russell 2000 was down better than 4% on the day. And, the Russell 2000 is now down 1% since Trump was elected. A couple of weeks ago, it was up 9%. So we've had a 10% decline, now a full-blown correction in the Russell 2000. The QQQ was down, that's the NASDAQ 100, was down 3.6 today after hitting a record yesterday. In fact, several NASDAQ stocks had some pretty big reversals today where they hit new highs and then they got clobbered later in the day after the rate hike. But everything was down except the dollar. Gold was down about $60 an ounce today. It's up about $10. Now it's up $30. I don't know. So now it's back above 2,600. It's just regained. I don't know what just happened. I looked at the price of gold 10 minutes ago and it was up $10. Now it's up $30. So it's regained half of the $60 loss already. So we're back above 2,600 at 2,612, but we were down below 2,600 when trading closed. But what's amazing? The gold stocks, again, got absolutely hammered today, right? Barrick Gold was down 4.5%. I'm giving you the big ones. Newmont Mining was down 5.5%. This is how ridiculous it is. So gold, before this $30 rally, because I looked at the numbers before this rally. So before this $30 rally that we're having right now, gold was down about 7% from its peak, about $200. That's it. I mean, right now it's down less than $200 from the peak, but that was 7%. If you look at Newmont Mining and Barrick Gold, Barrick Gold is down 13% year to date. 13%. Newmont is down 8%. Gold is up 25%. I've never seen a year like this. 25% increase in the price of gold. Yeah, it's not the 30% that it was, earlier, but 25% up is a hell of a year. One of the best years for gold. And these stocks are down. Now, it wasn't too long ago, before Trump was elected, the gold stocks were up more than gold. Now, they weren't up a lot more like they should have been, but they were up more. But since their peaks, even though gold is only off 7% as of earlier today, Barrick Gold is 35% below its high. 35%. Newmont Mining is down 33%. These stocks are trading at less than 12 times earnings. So what does that tell you? About the sentiment. They're less than half of the market multiple. Hey, you know, I'm having these technical difficulties. I was trying to text. So, Paul, you got to let me know when to do the commercial break because you didn't give me a timer. So I have no idea how long I've been talking. So you got to send me a text and let me know when I need to break. I was hoping to do that without having to say it. But anyway, that's what I had to do. So where was I? Yeah, so the fact that these stocks are down so much shows you how negative the sentiment is in gold. But how negative the sentiment is in gold, that's how positive it is in everything else, right? Because it's the mirror image. You have crazy optimism on the overall stock market, ridiculous optimism in Bitcoin, but extreme bearishness, extreme pessimism in gold. Now, what investors don't understand, what the Fed doesn't understand, and I'll get to that. I'm going to take a quick break for this commercial. I'm going to come back and I'm going to talk about what it is that the Fed and investors don't understand. So stick around. I'm coming right back. As a business owner, I know the challenge of navigating unpredictable markets, interest rates, and inflation. That's why having the right tools are essential. NetSuite streamlines operations and scales with growth. Over 40,000 businesses have already future-proofed their businesses with NetSuite by Oracle, the #1 cloud ERP. NetSuite brings accounting, financial management, inventory, and HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. When you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. Whether your company is earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. NetSuite is the platform that I would choose, and you should too. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/gold. The guide is free to you at netsuite.com/gold. That's netsuite.com/gold. All right, now, before I get into the Powell press conference and dissecting some of the things that he said, the main reason that Jerome Powell has so much confidence in the Fed's ability to slow down on the rate cuts is because Powell is convinced, and I guess everybody else on the Fed, that we've got a fantastic economy. I think he described it as remarkable. We've got this remarkable economy with a very strong labor market. This is what Powell believes. And so he doesn't think that the economy needs these rate cuts to support it. And so he can keep fighting inflation. But Powell still doesn't understand that the economy is not strong. It's not strong at all. When he was asked at the prior press conference, or I don't know if it was a press conference, maybe it was a press conference, if he learned anything from the election, and he refused to comment because he didn't want to talk politics, which, you know, it really wasn't a political question. But what Powell should have learned from the results and the exit polls from the election is that the economy is not strong, because the people living in the economy told everybody that the economy was weak. They voted for Trump because the economy was weak. If the economy was strong, they would have voted for Kamala, but they didn't. They voted for Trump. Also, one of the reasons that Powell thinks the labor market is strong is because of all these jobs that we've created. Well, most of them have been eliminated from creation because they were never created in the first place. Powell is completely ignoring the massive downward revisions in prior payroll numbers. And more downward revisions are coming. And they're ignoring even more bad economic data that came out this week. In fact, you know, one of the data points that came out this week that nobody even talks about is the current account deficit. This is for the third quarter of 2024. Our current account deficit for the quarter was $310.9 billion. That's a record. We've never had a current account deficit that big in one quarter. We blew through the record from Q1 of 2022. And this is a record, and it's going up. Look, wealthy nations have current account surplus, right? You look at Japan, Germany, China, Switzerland, Singapore, all these countries, Scandinavian countries, the wealthy countries, they all have current account surpluses. Only the United States. Well, I think Great Britain has a deficit. They're pretty screwed up over there. But all the real wealthy countries have current account surpluses. America, at the height of its economic power, we had the biggest current account surplus of any nation. So normally, a current account surplus and being a strong, wealthy economy, they go hand in hand, right? It's like a real scorecard of your economy. Are you generating a profit or are you operating at a loss, right? It's like a P&L on a nation. You want to have a current account surplus. That includes your trade position and your net investment position. What makes up the current account are goods, right? We have a huge deficit in goods, but we also have a deficit in net income. What that means is that foreigners earn more money on the investments they have in America than Americans earn on the investments that they have abroad. And so we're just a two-time loser here, and we've got this huge current account deficit. Multiply that out by 4. If we keep doing that, that's $1.2 trillion a year of red ink hemorrhaging out of the country. And they're saying that we got a strong economy, that we got a remarkable economy. What's remarkable is that we can even survive with this enormous current account deficit. Any normal country would be having a currency crisis and a bond crisis if they put up numbers like this. But we get a pass. We can get away with it because of the status of the dollar. Again, here it is going up once again. We have the dollar rallying. That means we've got more rope to hang ourselves with, and that's exactly what we do. We run even bigger deficits because our overvalued dollar allows us to do that. But, another thing that's going to happen with the strength of the dollar, which I believe is temporary, but, it could be temporary for a little while longer. This is going to put a lot of upward pressure on inflation in Europe, in Japan, in South America, up in Canada. I mean, look at the Canadian dollar. Look at the Australian dollar. These currencies are getting decimated. That's going to put a lot of upward pressure. So these countries have been cutting interest rates because their economies were weak. Well, now they're going to be getting strong inflation. So we're really exporting this inflation around the world as the dollar is strengthening and these other currencies are coming down. That means all these commodity prices are moving up. Oil is not moving up for us, but it's getting a lot more expensive down under and north of the border in Canada. So you're going to see upward pressure on inflation in the countries that are now cutting rates because the economy is weak. Well, now what are they going to do? That inflation is going to get so much stronger, right? They're going to have to start tightening policy. There's going to be a lot of pressure, but of course, that's just going to make things even worse. I mean, all these inflation chickens are coming home to roost, but they're coming home here too, because interest rates, I think, are going to keep rising and the stock market's going to keep falling. I think we could have entered a bear market. This could be the beginning of it. I even posted that on X yesterday. I said, this could be the top. We could be starting a bear market because there was so much crazy optimism. Nobody thought the market can go down, which meant that's probably what was going to happen, right? Because there was every reason to be bullish and no reasons to be bearish, according to the mainstream, which is reason in and of itself to be bearish. But we get a bearish, a bear market in stocks. That's the reverse wealth effect. Long-term rates go up. Mortgage rates are about to spike up. This is going to be another negative for the housing market. I can already feel some cracks building in the banks. Everybody was expecting more rate cuts. We get new highs in long-term yields. We moved back above 5% in the 10-year, which I think we're headed. We're 4.5% now, but we could be up at 5% very quickly. We could be looking at more bank failures. And I can also imagine, Donald Trump is coming into office. He's not going to like it walking into a bear market. When he just went down to the New York Stock Exchange and rang that bell, and he's so excited, because he looks at the Dow Jones as a barometer of his presidency, and he's going to see the market tanking. That's not going to be something that he's going to be happy about, especially if the Fed is taking away the punch bowl when he wants it spiked. So there's going to be some fire there between Trump and Powell, because Trump, of course, is going to want easier money to prop up that market if it's falling, and to prop up the whole economy if things start to go south, which they probably will. And Powell is just talking about, again, this remarkable economy. Well, the whole thing is being downwardly revised right in front of his eyes. I think he's got a big ego. He doesn't want to admit that the economy is weak, because that would be an admission that the Fed screwed up. In fact, one of the things he said in the Q&A, and I'm going to get to that, but he was bragging about how much progress has been made in reducing inflation and how little damage has been done to the economy. He said, look, nobody thought we can get inflation this low, even though it's not down to 2, it's 2.5. Nobody thought we can get this low without causing a recession. And look, we did it. No, he didn't do it. They did cause a recession because we're already in one. We've been in one for a long time. It's just that they haven't done enough revisions in the data to reveal it. But the voters knew that we were in a recession. That's why they voted for Trump. That's why they told the exit poll people, I voted for Trump because the economy stinks, because inflation is too high. And in fact, Powell, he dismisses it. He says, well, the reason people don't like inflation is because we had a huge increase in prices. Yes, thanks to your policy. And he says they haven't come back down. Of course, they haven't come back down. And so he says people are upset because it's going to take many years for their wages to catch up to prices. Yes, then why did you let this happen? Why, Jerome Powell, did you let the inflation genie out of the bottle? Why did you say that we need to let inflation run hot to make up for all the years that it was slightly below 2%, right? Well, now look at it, right? And now it's going to take a couple of more years, even according to the Fed, before inflation goes back down to 2%. And that means that prices are going to keep rising, probably more so than wages. So we have a weak economy. I think the Fed is taking false credit for having engineered this miracle that is going to unravel before their eyes. But there's going to be a lot of pressure, I think, from the incoming administration on the Fed to stimulate, to do something to prop up the economy, to prop up the markets. And again, I think the only reason that Powell is talking tough on fighting inflation and indicating that, hey, they said that it was this tough call, that maybe they weren't going to cut 25 basis points. And in fact, if you listen to what Powell said, it made no sense to cut at all. And it makes no sense to even indicate that more cuts are coming. I mean, he still said that, we're probably going to cut rates in 2025, even though inflation is higher than we thought, and even though it's heading back in the wrong direction. If that's the case, they should be basically taking all rate cuts off the table. He all but took rate hikes off the table. One of the questions that he got in the Q&A was if the Fed would consider, or are they going to take off the table a rate hike? I think that was, are you going to take out of consideration, or can we at least know that we're not going to get a hike next year? And Powell said, well, I'm not taking anything off the table. But he said that that's not our intention, or that's not our base case, or something like that. He says, look, I don't think we're going to be hiking rates, but I'm not taking a hike off the table, right? The market didn't want to hear that. The market wants to hear, oh yeah, there's no way we're hiking rates, but he doesn't think he will. He should be hiking rates. Now, I agree. I don't think the Fed's going to hike rates. I think the Fed's going to cut rates next year. They're probably going to cut rates more than 50 basis points. Now, I don't believe they're going to be able to get all the way down to zero. But if they have to do that in order to restart QE, then that's what they're going to do, because that's the big change. QE is coming, and it's coming despite the fact that inflation is going up, because the recession that Powell thinks he averted or avoided is coming in full force. And it's going to come despite tax cuts that we might get from Trump. In fact, we might get the tax cuts during the recession. They may score it properly. Once Biden is out of office, I guess there's not as much pressure to cook the books. In fact, I already can see this whole script or show playing out, because so many people are convinced that we have a great economy. Academia, Wall Street, media, great economy, fantastic economy. Trump was just handed this, miraculous economy from Biden. The Biden, I guess the voters didn't realize just how successful Bidenomics was, for some reason. And so we had this great economy, and then Trump blew it. Here he is, only in office for a few months, and he takes this great economy and turns it into a recession, right? They're going to blame the whole thing. Not that, Trump is the reason that we're going to have a recession. We're going to have it anyway. But he'll be the fall guy because it's going to happen on his watch, and Biden will have gotten out of Dodge before they officially acknowledge it. So we may get those tax cuts as part of the fiscal stimulus. But as I mentioned on my last podcast, we already have the biggest fiscal stimulus right now in history. We're running bigger deficits now than we were when the economy was shut down for COVID, right? The whole economy is on fiscal life support. The problem is the Fed is unplugging the monetary life support, and that's why we're dying. And so the Fed is going to come back in, with a fatal dose, I think, of QE. And so that's why this dollar rally is not going to last. The sell-off in gold is not going to last, because all this tough talk by the Fed about how they're going to, keep rates higher and fight that inflation, right? We're not going to accept. In fact, somebody asked Powell in the Q&A, will you accept inflation above 2%? Will you accept 2.5%? And he said, no, absolutely not. Of course, he's not going to be around long enough because he's out of there in a year or so. But he said, no, the Fed is not going to rest until inflation is 2%. We're not going to accept a higher rate. No matter how long it takes, that's our target. And so what's going to happen, though, is the Fed is not going to be able to follow through because of the unexpected weakness in the economy and the labor market and the stock market. Bear market in stocks, spike in unemployment, recession. It's not going to matter where inflation is. The Fed's going to cut. And that means inflation is going to get worse. That's stagflation. That's the one thing that Powell admitted they've got no plan for. They're just hoping they don't have it. Well, they're knee deep in it. And the markets haven't figured it out. So, it's going to be a big reversal when they do. Anyway, we got one more commercial break, so stick around. I'll be right back. We all want to perform at our best, but sometimes the nutrients we need are hard to get through diet alone. In a perfect world, we would all get enough of the nutrients we need for high-level performance from our diets alone. But this is the real world, and the truth is everyone could use some help in continuing to find a new personal best day after day. The Momentous 3, protein, creatine, and omega-3 are the 3 nutrients that expert research shows are the foundation of long-term health. Taking them daily supports every cellular function of the brain and body, from muscle recovery and growth to focus and energy. The Momentous 3 is the easiest way to drive the biggest impact on health span. Momentous also takes it a step further. As a supplement company determined to bring trust and transparency to a space lacking both, all their formulas are designed with human performance experts and are NSF and Informed Sports certified for use by professional and collegiate athletes. That means sourcing ingredients for quality, not just what's cheapest, and what's on the label is exactly what you're getting. I just received the delivery from Momentous because I take my health and performance seriously. So if you're interested in making a true investment in your health, why not join the best in human performance and be part of the change in raising the bar on supplements? Just go to livemomentous.com, MONENTOUS.com, and use the code GOLD for 20% off your new routine today. That's livemomentous.com with promo code GOLD to get 20% off. All right, before I get back to the Fed, I might as well mention Bitcoin today. Bitcoin, since my last podcast, I think it was on Monday, or maybe yesterday. It was yesterday. Bitcoin made a new all-time record high. It got close to 109,000. It's hard for me to read the writing there on my screen. I know it was well above 108,000. Well, as I am speaking now, it's barely holding on to 99,000. So maybe that 100,000 Bitcoin party has finally come to an end. Of course, most people will have stayed much too long at that party. We'll see what happens to shares of MicroStrategy stock. Saylor bought more Bitcoin. He announced on Monday another $1.5 billion spent buying Bitcoin. And I noticed just a lot of PR coming from Senator Loomis and other people on the Bitcoin Strategic Reserve. And now they're trying to spread these rumors that in order to bypass Congress, because there is no appetite in Congress. I mentioned the increase, the Social Security Fairness Act, right? That passed the Senate. I mean, it's in the Senate now. It passed the House. 327 yay, 75 nay. So the majority of Republicans voted in favor of increasing spending on Social Security, right? There's no fiscal conservatives. These are all rhinos. There isn't a prayer of any meaningful cuts being passed by this Congress, right? The Doge might as well pack it up, turn off the lights at the Department of Government Efficiency, because nothing is going to be accomplished. They got a much better chance of going at it through the Supreme Court. And the only way Trump is going to get anything done is if he refuses to sign the increase in the debt ceiling or any of these continuing resolutions. But he's not going to do that. So the spending is going to keep rising. But so Bitcoin, we'll see. The point I was going to make is that Trump is not going to sign a presidential decree declaring Bitcoin a strategic asset and just buying it, authorizing the Treasury to buy it without the U.S. Congress. It's just not going to happen. Plus, Trump's going to have a lot to deal with, right? Bitcoin is going to be pushed aside. He needed the support of the crypto people to get elected. He doesn't need you people anymore. He's already in office. So, you forget about it. He's going to be facing a falling stock market, recession, maybe a financial crisis. There could be a financial crisis early in Trump's first year. So he's got bigger fish to fry than trying to pay back his donors and voters on Bitcoin by giving them an exit. I think Donald Trump probably figures that he's square, right? He helped get Bitcoin above 100,000, and he gave everybody a chance to sell. All of his donors that gave him big bucks had plenty of opportunity to sell their Bitcoin and cash in on their Donald Trump investment. So he's going to have much bigger problems to deal with than trying to waste time with a strategic Bitcoin reserve. That would only add to America's problems. It would add to inflation, add to the deficit, make the economy weaker. And so we can't afford to do that. So that's not going to happen. And I wanted to talk about a couple more data points, too, that came out this week. Look, Empire State Manufacturing Index on Monday. Now, it spiked up last month, right? A crazy spike up to 31.2, right? They were looking for a 9.1 for December. We got 0.2, right? Way below the estimates range from 2.3 to 16.6. We got 0.2, right? Empire State Manufacturing. We got the PMI composite. And even though the service index came out above expectations at 58.5, manufacturing, which is the key, plunged to 48.3 from 48.8 from 49.7 the prior month to 48.3. Weakness well below the lower end of expectations was 49. Look, manufacturing is in a recession, but look at the retail sale numbers, because these are important, because everybody wants to look at retail sales to see how the consumer is. And they don't adjust these things for inflation. So retail sales were up 0.7. And everybody is really excited. 0.7, because that's more than the 0.5 that we expected. Except pretty much all the gains are auto sales. But I looked at the numbers. it's not because consumers bought more cars. It's because they paid higher prices for the cars they bought. That's what drove the sales, higher prices. And if you strip out vehicles, retail sales only rose by 0.2. And they were expected to rise by 0.4. So even though the headline is, hey, retail sales were above estimates, the real number, when you take out the fact that cars were more expensive, the real number was half expectations. And if you look at 0.2, prices rose by more than 0.2. So real retail sales are falling. They are not rising. This is not a strong economy. This is a weak economy. The consumer is weak. The consumer is buying less, but paying more. That's what the numbers show. And he's going into debt to do it. And again, this proves Powell keeps talking about the fact that we've got tight money. We're well into restrictive territory. We never even came close to restrictive territory. We have easy financial conditions. Why do you think the NASDAQ just hit an all-time record high? Think that happened because we got tight money? It's because we got easy money. Do you think Bitcoin went up to 109,000 because we got tight money? No. Everything is behaving like we got loose money. Look at the rates. I mean, Michael Saylor is borrowing money at zero to buy Bitcoin. You think he could get all that cheap financing if we had tight money? Look at the junk bond market. Look at the high yield market. Money is cheap. You know, the real rate of inflation is much higher than the government admits. We have negative real interest rates. If you put a real inflation rate and then discount those interest rates, debt is at record highs. Everybody is borrowing. I said, government has never been borrowing as much money and spending as much in deficits as it's doing right now. Could the government be this reckless if we had tight money? Of course not. That's the point of tight money, is to force everybody to tighten their belt. No one's tightened anything, right? In fact, they've gotten rid of the belt. They removed the belt and untucked their shirts, right? This is easy money the whole time. That's why we've got, on pace maybe for a $4 trillion budget deficit. So it's excess on Wall Street, excess debt and credit on Main Street, because the Fed never got into restrictive territory. Now, why? Why did the Fed stop well before rates ever got restrictive? Because the wheels started to fall off the bus. Signature Valley Bank, Silicon Valley Bank, or Signature Bank, Silicon Valley Bank went belly up. The dominoes started to fall, and they would have kept on falling had the Fed kept on hiking. Well, they stopped hiking, and they, stopped the financial crisis. Well, now that they've taken away a lot of the easing, this is like a hike, right? Even though the Fed cut rates today, for all practical purposes, they just hiked them, right? Because they're less loose. They took away some of that punch bowl. And so I think this is like a hiking cycle that the markets didn't expect. And so we're going to resume the financial crisis that was interrupted when the Fed stopped hiking. Now that they've kind of started a tightening cycle, we're going to resume that financial crisis. Look at the industrial production numbers that came out. These are horrible numbers. Industrial production dropped by 0.1%. Dropped. So we got a booming economy. We got a remarkable economy, and our industrial production is going down, right? And they revised the prior month down more than it was originally reported. It was down 0.3, and now we found that it was down 0.4. I wonder what they're going to revise this month's to. They were looking for a gain of 0.3. Manufacturing output was supposed to rise by 0.5. It only rose by 0.2. But you know what? They took last month's decline of 0.5 and they increased that to minus 0.7, which means we're basically unchanged from the minus 0.5 that we had the prior month, which is now minus 0.7. Capacity utilization tanked. It was 77.1 last month. They expected it to notch up to 77.3, and instead it tanked to 76.8. So we're utilizing less of our capacity because the economy is weak, not because the economy is strong. So Powell is just ignoring all this because he wants to claim the economy is strong because he wants to take credit for it, right? He pulled off this miracle. Nobody thought he could do it, and he did it, right? So he's going to keep on saying this, and at some point, he's not going to be able to continue telling that lie. Anyway, let me get back to some of the lies from the press conference that we had today. So the first question he got was a good question. I think it was a woman. I don't remember her name, but she just said, "Hey, Powell, why cut rates at all? Right? If inflation is high, like you said, and it's sticky and it's not going down, and the economy is stronger than you thought, why are you cutting rates?" Right? Which is a good question. And he really didn't have a good answer as far as I'm concerned. He cut rates because the markets expected it. He didn't want to hurt the markets. Well, guess what? The Dow was down 1,100 points, and that was the best performing of the indexes, with the NASDAQ down over 3%, the Russell 2000 down over 4%. So he disappointed the markets without even trying. But I think that's the only reason. But yes, he was talking out of both sides of his mouth. If you just heard what he was saying, it made no sense to cut. In fact, it made no sense to indicate that more cuts are coming. What he should have said is, look, we can't cut at all. We need more, inflation needs to really start to break. But he still is, maintaining that he thinks we're going back down to 2%. Even though all the indications are we're not. I mean, the only thing that's happening now is we got a stronger dollar, which should help. But I don't think it's going to be enough to offset what's already baked into this. But that stronger dollar is going to exacerbate the growing inflation threats outside the United States, which I mentioned earlier in the podcast, which nobody is talking about. He mentioned that the downside risks to the labor market have cooled. He's not as worried about the labor market as he was. I don't know why. He should be a lot more worried. And he said, but it's cooled off. It's not as red hot as it was. So he's welcomed the cooling, but he doesn't even think it's going to cool anymore. I don't know why, but we've gotten so much negative numbers with all these downward revisions to employment. Let me see. Talked about policy still being restrictive. But he said he wants to watch inflation carefully. See, this is another thing the markets didn't like. We're going to watch inflation carefully before we make our next move. And so what he's telling the market is if we keep getting these hot inflation numbers, if we don't get more progress, we're not going to make more cuts. So even though the Fed is signaling that we may have 2 cuts in 2025, we may not have any cuts. If the inflation numbers don't come down, those cuts are not going to happen. And if those cuts are not going to happen, the market's going down. Stock market's going down, bond market's going down, real estate market's going down. In fact, the Fed cut rates today and the bond market got clobbered. So stocks and bonds, regardless of what you own, they both went down. The markets are not cooperating with the Fed. Again, that's why I think the Fed's going back to QE. The only way they're going to get a meaningful reduction in long-term rates, at least short-term, a short-term reduction in the long-term rates, is if the Fed buys those bonds. And the only way the Fed's going to be able to buy those bonds is if they print the money to do it. And so they got to go back to QE. Now, it's not going to work long-term. I think that's going to blow up in their faces, but, they're going to do it anyway because they got nothing else. Again, he kept talking about how the economy is in a really good place. He said that a few times. We're in a really, really good place. We're in an awful place. We're between a rock and a hard place. We are nowhere near a good pace. He said, but rate cut path is slowing due to stronger growth and higher inflation. Again, he admitted that. Our path of rate cuts is slowing down now because the economy is stronger than we thought, which it's not. I don't even know where they're coming up with that. But inflation is higher than they thought. That is a true statement. And it's actually a lot higher than they thought, and it's going to get a lot higher. And that's when he talked about the natural rate being higher. And he talked about more uncertainty. He said there's a lot more uncertainty now with inflation. So the Fed thinks that inflation is going to come back down, but they're not really certain, or they're less certain than they were before. And that also spooked the markets. Then again, I already mentioned this, but he acknowledged that it's going to take years for wages to catch up with prices. Problem is they're never going to catch up because prices are going to start rising a lot higher. Yeah, he said he's not going to settle. I already mentioned a lot of this stuff. I'm just looking at the notes that I made while I was listening to him talk. In fact, I was listening, getting ready to go on Fox Business with Liz Claman. So I was, listening and, doing other things. They would not settle for 2% inflation. And he would not rule out, not rule out rate hikes. So that's those are the notes that I made. So I kind of already covered most of that stuff along the way. But this was probably, in the scheme of things, the most hawkish press conference he's made. Right? I mean, and again, he's not really a hawk. It's just less dovish. But this is not what the markets wanted to hear. Powell basically said, I'm not really sure what's going to happen. Inflation is higher than we thought. It's not coming down the way we thought. And so we're going to have to scale back these rate cuts, and we're going to have to wait and see. It was a close call. We were thinking about not cutting rates today. In fact, there was one dissent. There was one voice on the Fed and the FOMC. And there were some non-voting members, too, that expressed a disagreement with cutting. So there was some division at the Fed. Not everybody wanted to cut. And now they're not sure when the next cut is coming, if the next cut is coming. They can't even rule out a hike coming, which would be the appropriate policy because, they stopped hiking too soon. They never got restrictive. We need a lot more rate hikes. But again, the economy is too broke to handle them. The interest now on the debt, I think, is up to $1.3 trillion a year is what we're paying in interest. Remember, this is a moving target because every month more low-yielding debt matures, and it has to be rolled over at higher rates, and that is going to continue. The yield curve is now normalizing. You've got a normal yield curve going out from a 1 year to a 30-year. The yield on a 12-month treasury is 4.26. 2-year is 4.34. 5-year is 4.39. A 10-year is 4.51. And a 30-year is 4.68. That's all positively sloped. The only negative slope is a 6-month, which is at 4.28, which is slightly above the 12-month. And the 3-month is still higher than the 12-month and higher than the 6-month. But I think that's going to change over the course of the next few weeks. I think you're going to get the 12-month potentially moving above the 6-month. In fact, that's going to happen. And then you're going to have a positive slope yield curve from 6 months down to 30 years. So you only have a little bit of a negative in the 3-month. And that may even flip. But what's going to really happen that's going to be a big negative for the market and the real estate market because of mortgage rates is going to be the steepening of that curve as we start to see the longer duration bonds moving up even more as a result of the loss of confidence in the government's ability to rein in the deficits. As people start to realize that what's happening with Elon Musk and Ramaswamy and all this is just a bunch of talk, right? Nothing is getting reduced. We're going to be in a recession. Nobody is going to be talking about cutting spending in a recession. It's like, there's no atheists in foxholes. There are no, hard money guys, monetarists, Austrians in a recession. They all want stimulus, even though the only stimulus that works is to cut government spending. See, the Keynesians don't get that. Government is the drain on the resources of the private sector. And if you really want to stimulate the economy, you got to shrink the government. It's like if, somebody is running in a race and they've got a backpack with 50 pounds of weights in the backpack and they're trying to run a race, how do you stimulate that guy? Do you put more weights into the backpack? No, you take some of the weight out so he has less excess weight that he's got to carry around. He can run faster and for longer if you remove some of the burden that he's carrying. And so that's the economy and government. Government are the weights in the backpack of the runner, right? Slowing the economy down, with burdening it with extra regulations and extra taxes. And yes, I think we'll get some deregulation out of Trump because that doesn't cost the government any revenue. But what's going to happen when the economy turns down? It's all going to be about stimulus. Nothing is going to get cut, right? And the politics won't let it happen. Who's going to vote to cut anything? Oh, when the economy is hurting, when people are hurting, people are losing their jobs. We can't cut government programs when people need them. We can't lay off government workers as if we were going to lay them off anyway. But how can you lay people off when unemployment is rising? So it's going to be bigger spending. It's going to be higher inflation. That is what's coming. And the markets are not handicapping that at all. The markets just think, oh, well, the economy in the U.S. is great, and the Fed's going to keep hiking rates, so the dollar is going to go up. And they're not realizing how what they believe is going to happen is impossible because we can't have the strong economy with rising interest rates when we have so much debt. And inflation is headed higher, not lower. And so we're not going to get this great economy that the Fed claims we have. We're going to have recession. And so there's a huge disconnect right now between economic reality and this economic fantasy. But it has caused this upward trajectory in the dollar. Again, I don't know how much higher the dollar is going to go than it is right now. I mean, it certainly could move higher, and that could put more downward pressure on gold. But, remember, in terms of foreign currencies, gold is holding up. And, it's not up $30 anymore. It's up $24, but it's still back above 2,600, 2,608. Look, I think gold is acting very, very strong. I read an article that the Chinese have been buying up a lot of gold recently. They're not talking about Bitcoin. They're buying real gold, and they've been buying a lot more than they've been letting on. I know there were some rumors, the Chinese don't want to buy gold now that Trump is there threatening them with tariffs. You know what? That means they want to buy even more gold. Whatever the U.S. doesn't want them to do, that's exactly what they're going to do. So take advantage of the weakness in gold. Silver also got hit. It's back below $30 right now. It's at $29.50. I don't think it's going to stay below 30. Again, I think this is where the support is in silver. So we should be buying the dip. You should be calling up the guys over at Schiff Gold or just going onto the Schiff Gold website and fill up your shopping cart, with gold and silver while they're on sale. And yeah, I know that we're seeing the foreign markets coming down, mainly because of the dollar going up. So a lot of the weakness in the foreign markets is currency related. But I think stocks are going to go down a bit too in sympathy with the U.S. stock market. But the U.S. stock market is a disaster waiting to happen. And the only way to avoid that disaster is to create a bigger disaster in the dollar. So either the stock market crashes or the dollar crashes. One of those two things is going to happen. I think it's the dollar, although the stock market will go down first. And that's one of the reasons that the Fed is going to go back to QE. The Fed is going to sacrifice the dollar to prop up the stock market and the economy and the bond market and the U.S. government. All that's coming. So in the meantime, just keep on buying these foreign stocks. I keep on adding, I think, to your Pacific accounts. Keep on taking money off the table in the U.S. stock market. I know people just think, hey, it's going to be great because Trump is president. Look, yes, it's better that Trump is president than Harris. The market was going to go down with Harris. The market was going to have to go down either way because the market was so expensive. But the worst of the economic downturn, the worst of the consequences for the years of fiscal and monetary profligacy, they had yet to be paid. That was going to happen. This was, guaranteed. It was assured to happen. And, that was one of the concerns I had for Trump, was that it all blows up on his watch. But one of the reasons I did want Trump in the White House when it hit the fan was because it would be much better to have Trump and his team than Kamala and her team in the aftermath of the collapse. Not because I thought that electing Trump would prevent the collapse. I just thought that electing Trump would put us in a better position after the collapse to do the right thing. Now, we may not do the right thing with Trump either, but at least we got a shot. I thought with Kamala, we had no shot. Anyway, that's it for this 1000th episode of the Peter Schiff Show. You know, I'm not going to be in my studio for the next few weeks. We're going to be leaving for Christmas vacation. I don't plan on being back in the studio until I think around the 12th of January. So that doesn't mean there's not going to be any more podcasts between now and then. I'm sure there's going to be a few of them. I'll be doing them on the road. I'll be doing them from Connecticut or wherever I happen to be over the holidays. But this is the last one probably from the studio. And even this doesn't even look like the studio. By the way, if you want to check out what this studio looks like, since I just got my laptop, this is all the equipment I got in here for the studio that we built. So there's a lot going on in here, and I'm ordering some more equipment. So we're going to actually make it a little better. You see all the music equipment that's in here. A lot of that is for my wife. Oh, by the way, I forgot to mention, you know, she's got a new song. Her third song, Love Is on Fire, is coming out, I think tomorrow or Friday. Her third song is dropping from, her album, Funny Money. I really like the first two. This one is another great song. In fact, she's already remixed. That's coming out too in the next couple of days. A remix of GYB is coming out. So she's got GYB, she's got Jerk, and now Love on Fire. Those are the first three songs. So if you haven't heard any of her songs, you should go to Spotify and check it out, Laughing Cat. Listen to those first two songs, and then get ready for the third song coming out in a couple of days. I'll throw a link into her Spotify channel up in the description to this video. But yeah, I mean, they're great songs, and have a listen. You can enjoy them over the holidays. Anyway, that's it for today. Don't forget, give me the thumbs up if you like the podcast. Don't forget to comment. I do respond to a number of the comments, and sometimes I incorporate those comments into the next podcast. Bye for now.